You know, a lot of people think that market volatility is actually newsworthy. I'm going to tell you why it's not. I'm Matt Ross, president of Ross Financial. But first we get into talking about market volatility, I want to tell you a quick story. Out here in the Pacific Northwest, we have a body of water called the Puget Sound. And the Puget Sound typically every day goes in and goes out. And those tides will fluctuate the level of the water 10, 12, even 14 feet twice a day. Now, envision tonight you're watching the news and the news broadcaster comes online and says, ladies and gentlemen, breaking news. Puget Sound went up 12 feet today. Now, you might be thinking to yourself, gosh, it must be a slow news day today. But if that breaking news was just a little bit different, and if they were to say the level of Lake Washington rose by 12 feet today, now that would be something that would be newsworthy. So I want to talk to you about market volatility and why it's not newsworthy. The visual that you see before you shows a period of time starting from 1980 and goes all the way to the year 2020. And what you see are a series of gray bars and a series of red dots below each of those gray bars. And what we're looking at with those gray bars is what the S&P 500 finished the year at every year. And the red dots correspond to the lowest point that the stock market dropped to in each one of those subsequent years. Well, as you can see, that there are a number of years where the market finished above zero. Now, because there's so much information here, I want to direct your attention to the fact that out of 40 years of data, 30 of the years, you can see that the market was positive. You'll notice that by the gray bars that are either above or below the 0% line. So 30 out of 40 of those years, or 75% of the time, the market is positive. Now, if you look at those red dots, you'll notice that the majority of them are all negative, which means that in basically every single year for 40 years, the market at some point in time turned negative. And if you take all those intra-year drops, the average is 13.8%. So back to my original point. Market volatility is not newsworthy. Why? Because it happens every single year. Just like the tide in Puget Sound going up and down every single day. If $1 million invested were to drop 14% every single year on average, that would leave a person with about $860,000 left. That's not newsworthy. That's average. Now, if you'd like to connect with us, schedule a free consultation. There's a link right below this video. We look forward to talking with you soon.